Hello everyone, welcome to the 8th of our CIMA F3 Financial Strategy lecture recaps. This was on financing and investment. So the first thing we looked at was risk. Okay, remember we separated out our risk. We have business risk. Okay, this is the risk inherent in that type of business. For example, the risk of bad weather for fishermen. Nothing you can do about that. It's inherent in the business. It's a business risk. This is as opposed to financial risk. Financial risk is determined by your capital structure and effectively is your gearing. So the higher geared you are, the more financial risk you will have. Okay, so those are the two types of risk: business risk and financial risk. What we're really concerned with here is choosing our discount rate. We have three choices. We have our working average cost of capital, which we've already looked at. We have our risk-adjusted working average cost of capital, which we will look at, and our APV, our adjusted present value, which again we will look at. How do we choose which of these to use to get our discount rate? Well, if there's a change in the capital structure, we'll use APV. If it's in a different business area, we use the risk-adjusted working average cost of capital. If it's in the same business area and we have no change in capital structure, we'll use our working average cost of capital. So that's how we decide what discount rate to use. So the risk-adjusted WACC then, how do we use this? Well, remember the beta in CAPM? Well, it includes both financial risk, which is, remember, firm specific and dependent on your capital structure, and business risk, which will be industry specific. Okay, so your CAPM, your beta, includes your business risk and your financial risk. So if we are going to undertake a project in an unrelated industry, we will have a different business risk. Our business risk will change because it's a different type of business. But because our capital structure isn't changing, we have the same financial risk, the same gearing, because our capital structure has remained unchanged. So we have a project in an unrelated industry, it's a different business risk, same financial risk, because our capital structure is unchanged. So how do we do our risk-adjusted WACC? The procedure is first of all to select a proxy company, i.e. a company in the business that we're looking to take on. So it will have the business risk of the new industry, but it will have its own financial risk. So its beta will include its own financial risk. So what we need to do is we need to use this formula to ungear the beta of the proxy firm, i.e. to remove its financial risk, which will leave just the business risk. In that formula, VE is the market value of the equity in the proxy company, and VD is the market value of debt in the proxy. So we're ungearing their beta to remove their financial risk. We then have to re-gear their beta with our financial risk. So we're using their business risk and adding our financial risk to it to get a new beta. And in this again, the market value of equity is VE, and that's our firm because we're re-gearing. And VD is the market value of the debt of our firm again, because we're re-gearing with our financial risk. So that will give us a new beta with the business risk of the new entity or the new industry and our financial risk. So that will be what relates to us. That will be our cost of equity. So we can then go on to calculate the working average cost of capital. We use our re-geared beta in CAPM to get the cost of equity, and we calculate the cost of debt the same way as we do normally. So that is how we calculate the risk-adjusted working average cost of capital. So our adjusted present value then, how do we use it and when? Well, remember, if the capital structure changes by taking on the project, we will use the adjusted present value. The procedure for doing this, we find the ungeared beta. Okay, so we ungear the beta for the financial risk, so we're only interested in the business risk of the industry. We'll fill this into CAPM and use it as the discount rate. Okay, we'll then do our NPV calculation as usual. we'll use the ungeared discount rate as our calculation to calculate the NPV, and that's called our base rate NPV. So we then have to evaluate the financing effects. What we've effectively done is calculated an NPV but leaving out the effects of financing. We're going to assess those effects separately. So first of all, we have the issue costs. Remember that to issue debt will cost money, and we can have tax relief on that issue. However, the issue costs of equity, we have no tax relief on that, and we did a little example in class. Tax relief then, remember, we can get that on the interest, so we need to find out the present value of the tax relief, and we've done an example of that. We also may get subsidies on debt. If we have an increased debt capacity, if we're told in the question that this increases our debt capacity by a certain amount, we use the theoretical debt capacity, okay? And our pro forma for calculating the APV is our base case NPV using the ungeared beta. The present value of the issue costs then need to be subtracted. We add on the present value of the tax shield, and that gets us our adjusted present value. That takes us on then to the adjusted discount rate. If we see this in the question, this is the rate of return to make the APV 0, and we did the example of that in class, so look at your notes to remind yourself. So that was our lecture on finance and investment.